Ever wondered how the stock market works? It's not as complicated as it seems. Imagine a bustling marketplace not unlike a farmer's market, but instead of fresh produce, this marketplace deals in shares of publicly listed companies. Each share represents a piece of ownership in a company. When you buy a share, you're essentially buying a slice of that company, becoming a part owner, if you will. This marketplace, known as the stock market, provides a platform for companies to raise capital. When a company needs to fund new projects or pay off debt, it can sell shares to investors. This process of selling shares to raise capital is often referred to as issuing stock. So, whether you're an entrepreneur seeking funds for your next big idea or an investor looking to grow your wealth, the stock market serves as a bridge connecting your financial goals. So, in essence, the stock market is all about buying an ownership stake in a company. Now, how does this buying and selling happen? It's quite simple, really. The trading of stocks primarily occurs on exchanges such as the New York Stock Exchange or the Nasdaq. These are essentially marketplaces where buyers and sellers come together to trade shares. But how are the prices of these stocks determined? Well, it's a classic case of supply and demand. If more people want to buy a stock than sell it, the price goes up. Conversely, if supply exceeds demand, the price falls. This dynamic interaction between buyers and sellers is what ultimately drives the price of a stock. Furthermore, it's crucial to remember that the market is a reflection of investor sentiment. If investors believe a company is doing well and will continue to do so, they are willing to pay more for the stock, driving up the price. Remember, the price of a stock is all about how much someone is willing to pay for it. When we talk about investments, stocks and bonds often come up. But what's the difference? Well, stocks represent ownership in a company. When you buy stocks, you're essentially buying a small piece of that company and become a shareholder. On the other hand, bonds are a form of debt. When you buy bonds, you're essentially lending money to the company or government issuing the bond. They promise to pay you back with interest. So, when you buy stocks, you're buying a piece of the company. With bonds, you're lending money to the company. Ever heard of the S&P 500 or the Dow Jones? These are what we call market indices. Think of them as a barometer gauging the climate of the stock market. They track the performance of a selection of stocks, giving us a broad view of the market's overall health. They also act as benchmarks, helping us measure our investment returns against the wider market. So whether the indices are soaring or plunging, they give us a snapshot of the market's overall health. Investing is all about balancing risk and return. Picture a seesaw. On one side you have potential returns, on the other, risk. As one side goes up, so does the other. High-return investments often carry higher levels of risk. These might be startups with immense potential or volatile stocks that swing wildly in price. While these investments have the potential for big returns, they also carry the risk of significant losses. On the other end of the spectrum, you have lower-risk investments like government bonds. These are less likely to lose value but also offer modest returns. Understanding your own risk tolerance is crucial in this balancing act. It's about knowing how much risk you're comfortable taking on and what level of return you're aiming for. There's no one-size-fits-all answer here. It's a personal decision based on your financial goals, investment timeline, and your ability to withstand losses. Remember, understanding your risk tolerance is key to crafting a balanced portfolio. One of the most effective ways to manage risk is through diversification. This concept is like not putting all your eggs in one basket. Instead, you spread your investments across a variety of sectors and asset classes. This could mean owning stocks from technology, healthcare, and manufacturing industries, or holding a mix of stocks, bonds, and commodities. Why is this important? Well, if one sector or asset class underperforms, it's not a total loss because your other investments may be performing well. This balance can help mitigate potential losses. It's a way of saying, if one door closes, another might be open. It's crucial to remember that diversification is not a one-size-fits-all strategy. It should be tailored to your investment goals, risk tolerance, and time horizon. Finally, a word of caution. While diversification can help manage risk, it does not guarantee profits. It's simply a tool to help navigate the unpredictable waves of the market. Diversification doesn't guarantee profits, but it can help you manage potential losses. The stock market is not static, it evolves over time. As change is the only constant in the financial world, it is crucial to understand the importance of continuous learning. Just as a sailor continuously adjusts sails to the changing winds, an investor must adapt to the ever-shifting dynamics of the stock market. This adaptation is not possible without a commitment to ongoing learning. It's about staying informed, staying curious, and never ceasing to learn. Books offer a wealth of knowledge with timeless principles and strategies from financial experts, whether it's Benjamin Graham's The Intelligent Investor or Burton Malcolm's A Random Walk Down Wall Street. These resources provide invaluable insights into the world of investing. Courses, both online and in person, offer structured learning experiences. They break down complex financial concepts into digestible modules, guiding you step by step through the labyrinth of the stock market. Financial News is the pulse of the market. By following the latest news, you stay abreast of economic indicators, global events, and market trends that could impact your investments. Expert analyses offer a more in-depth perspective. By deciphering the thoughts of seasoned investors and market analysts, you can gain a deeper understanding of market dynamics and investment strategies. But let's not forget about regular research. It's the compass that guides your investment journey. By consistently examining company fundamentals, studying market trends, and assessing risk, you can make informed decisions that align with your financial goals. Continuous learning is not a task, it's a mindset. It's about embracing curiosity, fostering a love for knowledge, and understanding that every day presents an opportunity to learn something new. Remember, mastering the stock market is a blend of financial literacy, analytical skills, and a disciplined approach to investing. It requires more than just understanding the mechanics of the market. It demands a commitment to continuous learning, a hunger for knowledge, and the wisdom to adapt to change. Stay curious, stay informed, and happy investing.